Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week we're considering how to take decisive action amid uncertainty as we discuss the direction of investment travel for the remaining months of 2025. Now, the first half of this year was marked by both complexity and resilience in global financial markets. Markets entered the year with optimism buoyed by steady economic growth, positive surprises in earnings, and expectations that central banks would soon begin cutting rates. But this optimism was soon tested. By March, confidence wavered. A sharp escalation in US tariffs in early April triggered the steepest global equity correction since the pandemic. The S&P 500 fell more than 10% in just 2 days. Volatility spiked and the dollar weakened. Investors began to question the US's traditional role as the anchor of global markets. But this panic, too, proved short-lived. A pause in some tariff increases, coupled with robust earnings from AI leaders, drove equity markets to recover most of their losses by June. Most major indices are currently trading close to previous highs. Nevertheless, geopolitical uncertainty remains persistent, and the risk of renewed volatility is ever present. And the notion of US exceptionalism is also under scrutiny. While global equities are currently higher than at the start of the year, US markets have lagged the rest of the world. The dollar's weakened and long-term dollar bond yields remain elevated. The lessons of the first half then seem fairly clear. Patience and a long-term approach are rewarded, but only for those who are prepared to tolerate and navigate uncertainty. Against that backdrop, what are the key forces that will likely shape the investment landscape in the rest of 2025? Well, it's a delight to welcome back to the show Kiran Ganesh, Head of Investment Communications in UBS Global Wealth Management, to discuss exactly that. Kiran, welcome. Let's start by recapping 2025 so far. Sum up the year to date for us, Kiran.
Yeah, so it's been an unusual year, really, because we've had quite a lot of very negative events or what would normally be considered very negative events for markets. Of course, we've had the very significant tariffs being announced by the biggest economy in the world, the US. We've had geopolitical conflicts in the Middle East and between Russia and Ukraine, of course. We've had threats to the Fed's independence, with President Trump challenging the Fed to cut interest rates, and all of these things normally would be quite negative for financial markets. But in practice, what we've seen is equity markets up by around 8% year to date in local currency terms, and markets have actually been quite calm. Volatility is now below averages. Realized volatility is well below averages. So this sort of slightly eerie feeling that markets have been pushing on despite some of the headlines out there. So that's really the backdrop we face as we enter now the remaining months of 2025.
Well, yeah, and to that point then, Kiran, what are the key drivers in those remaining months? I mean, you've alluded already, obviously, Trump, trade, tariffs, that's just the tease. But what are the key things to look out for in the remainder of 25?
The big one from a risk perspective will be how big is the economic impact of tariffs. So a lot of the way the market's been trading so far this year has been around the headline number of tariffs, and when the Liberation Day announcements were made, and it looked like the US effective tariff rate would be coming close to 30%. We had a big sell-off, and then since then we've had a number of deals, and it seems like we'll settle at a number around 15% now, and markets have been responding positively to that because it's certainly much worse than it was at the start of the year, but somewhat better than was feared around the Liberation Day. I think now we're settling around that 15% number. The big question is, who is going to bear the cost of that? So will it be that exporters are going to cut their prices before they sell into the US? Will it be that importers will take the tariffs on the chin and suffer lower margins as a result? Or will the cost be passed on to the US consumer, and then they need to either find more money to pay for goods, or they simply cut back on their spending? So that's the big question right now. And the reason that we don't have an answer yet is because supply chains can be quite long. So you think about a good that was getting shipped from, say, China in April, maybe just before the tariffs, it may only be 2 or 3 months later that that's actually arriving on shelves. And when you factor in the fact that a lot of companies were pre-ordering before the tariffs were imposed to try and anticipate that and avoid the cost, the impact of tariffs is really only starting to get felt around now. So there is a lot of economic uncertainty around that. So that'll be a big driver. Then underlying all of that is the artificial intelligence theme, which has been, the biggest driver of markets over the past couple of years, even if it hasn't necessarily attracted as many headlines as trade this year. And, the extent to which that theme continues to power markets will depend a lot on how companies are talking about their investment plans in the space and how they're planning to monetize AI. So I think those are the two big ones that we're going to see for the remainder of the year.
Really interesting. And let's sort of turn around and look at this from the investor standpoint then, Kiran, which I always think is compelling. And I suppose if we look at what the backdrop you described should mean for investment decision making, well, there's various different things we could interrogate. One, I guess, is to look at equities. Can you phase in if you're a little bit underallocated to equities? I guess maybe. And then there'd be other considerations, continue to seek exposure to these underlying transformational innovations. You mentioned AI. There's a few interesting sort of investing strategies or things to keep in mind, right?
In the equity space, we think that's the right way to think about it. We've obviously had quite a strong rally and there are risks out there and things do just feel a little bit too quiet, as it were. So we think that ultimately this is a good market to be adding to, and particularly in some of those longer term themes like artificial intelligence, like longevity, like power and resources with big increases we're seeing in electricity consumption. But we'd just be a little bit cautious about going all in at this point, just because we've had, as I said, this very strong rally and there's a number of risks still out there on the economic front. So we think the best strategy for investors is to really have your shopping list ready across these themes. And then when some kind of correction happens, which we think is quite possible over the next few weeks, given some of the uncertainties, then use that as an opportunity to bring your equity allocation up to what you think is appropriate for your long-term goals.
And then, let's talk about a little bit more about the D word, diversification, because that's also relevant here, I guess, isn't it? Kiran, we've often discussed what times volatility mean. It's been interesting looking at USD and US Treasuries as well during this time of volatility. Is that changing people's perceptions of, for example, safe havens? Do people need to think if they're looking at diversification, I don't know, looking at maybe alternatives now in it with some fresh eyes? Tell me about this one.
Yeah, so I think when it comes to diversification and currencies, that's really been something which has been very topical this year because the dollar, which historically has been a currency which has tended to perform well in times of uncertainty, has performed very poorly this year in times of uncertainty. And part of that is because people have become a bit less trustful of US institutions, and many foreign investors have been thinking twice about their allocations to the US or whether they should hedge it. And that's led to dollar weakness. And I think that's really important for investors to be thinking about is when they are deciding what is the right currency mix in their portfolios to really reflect on their own situation and think about, what currencies do I need for my life? Am I spending the majority of my time in one place, typically where you live? You should normally then have the majority of your currency allocation in that place. But then do I have links perhaps to other countries? Maybe family members live overseas, maybe you travel frequently to a vacation destination that you like. Then keeping a small allocation to those currencies also makes sense because then you're covering your potential costs in that area. And we think that that's the right way to think about diversifying in currencies is really in a personal context, not trying to, take implicit bets on which direction an individual pair is going to go because, you don't want to subject your life plans to that. So we think that kind of more personal approach to diversification is the right one. And then more broadly at a sort of asset class level, we still do think that, high quality bonds, investment grade bonds are a good diversifier to have in portfolios. There's, a lot of discussion about government debt and deficits, but we do ultimately think that provided you've got that currency allocation right, then having an allocation to high grade bonds it does make sense in a broader portfolio. And we think that within the fixed income space, some of the riskier credits are just not offering as attractive risk return as some of the safer stuff. So we would still advocate in being invested in government and investment grade bonds alongside equities in a broader portfolio.
Interesting. And just while we're talking greenback, Kiran, I just want to ask you a little bit about the dollar and sort of various headwinds the dollar's facing. And of course, I think, there's questions around the Fed, Powell, and, some of the stuff that Trump's been saying. What did he call Powell a knucklehead or something the other day? Obviously, Powell's sort of tenure is coming to an end. When will that be? Sort of, I guess, in this next summer, is it? What do you make of this? It's quite interesting, isn't it, to watch? There seems to be a different sort of narrative around the Fed at the moment. People asking different questions about its independence even. What's your take?
We are expecting to see the dollar continue to weaken. It's been weakening very steeply so far this year, the fastest depreciation since the 1970s in the first half of the year. We don't think it'll depreciate quite so quickly going forward, but we think it will keep going down. And the reason is that the US, has a large current account deficit. Trump talks about this all the time. It is true the US imports significantly more than it exports. And what that means is that it needs to attract foreign capital flows to offset that deficit. And historically, the US has been really good at attracting those flows because people have been very interested in investing in US safe assets like treasuries. And people have also been, very much attracted by some of the investment opportunities in the US, particularly in the equity space. So it's been really good at attracting those flows to offset it. And that's kept the dollar really strong because actually those flows have been, very strong. Now, we think that going forward, because of some of these things like threats to the Fed's independence, which is leading overseas investors to question, maybe if there's more political influence at the Fed, is inflation now going to be running a bit higher because politicians will be trying to push the Fed to cut interest rates more than they otherwise would for political gain? Then that's leading to a lack of trust in the US institutions and less flows into things like treasuries and less willingness to buy assets denominated in US dollars. So we think that effect that you've got the US fundamentally importing more than it exports and reticence from foreigners to plug the gap, we think it does mean that the dollar will have to gradually weaken in order to attract more of those flows. So we think that should be expected by investors for the dollar weakness. When it comes to the Fed itself, we don't actually think that the political influence is going to have much effect. The Fed is still a committee at the end of the day, and you can change, one member of it. The chair is just one member. But provided the bulk of the institution continues to operate as it has done, we don't think it'll actually change policy all that much. But we do think that the signal impact of the president even trying to, put pressure on the Fed is clearly not a positive for the value of the US dollar.
Kiran, just sort of doubling back to the second half outlook, which I think was published back towards the end of June. One thing that struck me as interesting, there's a sort of recap in there, risk of asking you an obvious question, which may have a fairly obvious answer. But the piece was kind of called Action Amid Uncertainty. And there was an interesting section actually in the report, which sort of just detailed why a professionally managed approach is super important at all times, but particularly when we're navigating volatility, uncertainty. And of course, mistakes can be more costly, right, in volatile times. But there were some other interesting insights there just about, what the sort of the enduring value of the right kind of ongoing oversight, why efficiency is also important. Maybe you could just remind our listeners a little bit, and you can sort of bang the drum for yourself and your colleagues a little bit here, why that kind of management matters, absolutely more than ever during times like these.
Yeah, so I think there's a couple of things to point to. The one is that when you've got volatility, then that means that the balance of your portfolio will occasionally change. So you will sometimes end up with, much larger or smaller allocations, for example, to equities than is consistent with your long-term plan. And having a professional approach to kind of keeping those allocations in line with your long-term plan can mean that you're automatically selling or automatically buying, during times when markets are moving, which can allow you to take advantage of those movements. So I think that sort of systematic rebalancing is something that can really help investors during volatile times. Yeah, the second thing is a more sort of emotional control, is that when investors have a stronger degree of control over their portfolio, then they may be tempted to take this sort of action bias that something's happening in the markets, therefore I need to do something in my portfolio. And often that kind of behavior can be quite costly because, for example, earlier this year in April, it all looked pretty bad, right? We had the US president announcing very high tariffs on trading partners, markets were plunging. The obvious thing to do at that time would have been to de-risk portfolios. A more professional approach tends to take a longer term view and tends to look through these kind of events. And again, that's proven right. So I think overcoming some of that behavioral bias is something which some of the sort of more professional approaches can sometimes help investors with. Maybe just the final point to make is also just the process of coming to a decision about what portfolio is appropriate. I think is also something which is quite valuable. Many investors often just build up a series of assets over time, a bit of stocks over here, a bit of bonds over here, some slightly random collection of different opportunities that have come up over the years. And it may sort of make sense as a whole, but maybe it hasn't really been thought about in the context of, what is an investor trying to achieve? What are their longer term goals? What are their, wishes for their maybe future beneficiaries? So the process of thinking that through and coming to a portfolio which is geared towards achieving those goals, I think is also quite a valuable process that many investors sometimes overlook.
Kiran Ganesh bringing us to the end of this edition of the show here on Monocle Radio. For more, head to monocle.com or follow us wherever you get your podcasts. And remember, you can discover more and find out how UBS can help you by visiting ubs.com. I'm Tom Edwards. Thanks for listening.